What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello, welcome back to What's Making Headlines. It's Annie, Will and Ben with you this week, talking through what we've been writing about, seeing and doing here on The Advisor. Ben, how was your week?
Yeah, really good. A lot of interesting stories this week and a lot of work as well.
Lots. Loads of work. Will, for you, how was your week?
Good, yeah, another big news week.
Yeah.
Lots to get into.
Lots to get into. So I think one of the big things that started the week off with a bang was this new private sector report that landed from ASIC, and ASIC talking about private lending. Now, anyone's been following along, you might recall earlier this year, ASIC said they were going to be doing a big deep dive into the private credit space and looking at some of the issues that they were kind of seeing. So things like opaque fees, maybe some things not being quite what they should be, things not being labeled properly. And they had basically asked for some data to come out around what the private credit market looks like. And that was released on Monday. I have it here, this wonderful 46-page report called Private Credit in Australia by Nigel Williams and Richard Timms. And for anyone who didn't read the story, basically they were sort of saying private credit is still fairly small in Australia. I think they've estimated it to be around $200 billion. That's based on somebody else's assumptions, actually. I think that's EY figures. But they were saying it's about $200 billion in lending, and it kind of mostly encapsulates real estate. About 50% of it is real estate lending. And then there's lots of other things in there as well. But the report kind of goes into the things that are good about private credit in Australia and things that are not so great. And basically, the financial services regulator, ASIC, is saying we're going to kind of continue our look at the private sector space, the private credit fund space, and see how they're operating. They're going to be releasing a report later this year on it. But this report that they've just released, commissioned from these two, Nigel Williams and Richard Timms, about private credit, is really just setting the scene of being like, what does this actually look like? Quantifying what private credit looks like in Australia, talking about the different models, the different things that are being funded, and of course, again, some of the concerns that they're seeing. And then we should get a full report from ASIC, I think in November is what they were saying, along with some more action. Now, you might recall last week, they did put some stop orders in place on two private credit funds. So one from, that was a Latrobe Credit Fund, and one from Rely Mortgage Fund, and basically saying the way that they'd written their target market determinations wasn't exactly what they wanted and could have been misleading. So they kind of put a stop order in place until they'd fix them. I think Latrobe has now fixed theirs. But that was sort of really the first action we've seen ASIC take in the private lending space in quite a while. So we're continuing to see this, and we expect to see some more. But I'm just going to read from this delightful report if I can, and just the first paragraph of the introduction. And they said, private credit done well has a valuable role to play in the Australian economy. It can make an important contribution to economic growth. Private credit complements other modes of debt funding by facilitating financing for businesses that may not be able to access appropriate funding in the bank or public markets. This has partly occurred as bank capital rules have favoured income producing real estate lending and less highly leveraged corporate loans. But as we say, they've kind of gone on to be like, there's not the greatest practices here, and there's a lot of opacity. So ASIC has warned really that private lenders have to lift their game when it comes to this market. When you guys think about what you've written about the private lending market over the last year or so, let's say, Will and Ben both doing quite a bit for both your news and for the magazine, what's sort of been your overall takeaways about private lending in Australia? Ben, I'll start with you for that.
Yeah, from someone coming out the outside in, for me, it's always very much positioned as sort of an alternative solution for the circumstances where they can't sort of find what they need from the major lenders, perhaps. But yeah, does that mean it's getting enough regulatory oversight? Is it undergoing the same level of scrutiny as these major lenders do? I guess that's the question. That's probably what ASIC is trying to figure out now with this review. Yeah,
so basically being like, do we need to step in and put in some more rules? Because of course they're not banks. They don't have the same sort of level of oversight and strict rules that non-banks have, like private lenders. Will, how about you? What's your sort of overarching thought about private lenders?
Well, I would say the sell is quite often, it's more niche, or it's quicker, it's more flexible than a traditional lender. Or even the sell is that there's less regulation, which makes it quicker and easier, more convenient, as Ben said. which then you think ASIC, that kind of leads itself to think, is it under-regulated? Does there need to be more oversight? I don't know, that's what they hint at essentially in that report, isn't it? I'm sure after the review they'll have more to say.
Yeah.
And I think also demand for private lending's noticeably gone up. When you speak to brokers, that's definitely a clear theme. And you wonder if regulation tends to be slow, if it needs to kind of catch up to the rise in demand for private lending.
Yeah, and I think it's kind of interesting as well, like even the report's talking about the fact that banks increasingly are actually investing in private credit funds as well. So it's kind of like looking at where is this money coming from and who's sort of providing it. Is it kosher? What are the returns? How are you labeling it? And I think those are some of the things that they were sort of talking about in this report, is saying actually like sometimes the remuneration and fee structures can obscure the true cost of the fund management. So being like, what does it actually look like? Something like many funds retain between 50% and to 100% of borrower paid fees and net interest margins without disclosure. So being like, that's not great. We'd like to see people really estimating the total manager remuneration and the actual cost of the fund properly and making sure that's transparent. I think some of the other things we're also looking at, funds managed by the same group might have different valuation structures. So being like, how are they valuing things like LVR, for example? Is that done on the cost of completion? Is that done on the value of the property, like when it's fully like built? When is that valuation done? Who is doing it? Is it an independent party? And how frequently is it being done as well? That was one of the questions. And I think some of the other things are sort of also looking at really how does this look when it comes to borrowers? So being like, are we seeing consistent terms being used that are clear to a borrower? Do they understand what they're getting themselves in for? And really kind of saying, you know, do we need to actually look at standardizing or making just more clear and more transparent what things like secured debt is? Like, what does that actually mean? What is senior debt? And making sure that they're kind of used with a formal definition so they're not causing confusion. So lots of really interesting stuff in this report. And if you are interested in finding out an overview of private credit in Australia, then recommended reading a 46-page report. But I think this has really given ASIC something to deal with. And they were sort of saying, you know, like the Australian private credit market hasn't really experienced the credit cycle and associated downturn as the rest of the market has. And really talking about the fact that, you know, so much of it is tied to real estate. And of course, everyone at the moment is looking at real estate and the big property boom going on. So saying, well, what can we be doing here? So I'm really curious to see how ASIC is going to be potentially bringing in new rules about what private credit can do and how it can improve its transparency and disclosures. And hopefully we'll be delivering that before the end of the year. Anything else, I think, coming from your perspective when it comes to what ASIC's been up to this week? I mean, Ben, we've been kind of talking about ASIC, I think, for the last 10 days non-stop. There was maybe like 3 stories in one day in The Advisor that was about ASIC. And we were kind of talking about not only this sector, but also generally, I think, wanting them to be better. We'll get into that just after this. So where else, Ben, have we been seeing ASIC coming out this week? Where else have we been writing about them?
Yeah, so I feel like we've been writing about ASIC pretty much every day. Which normally there's a story or two, but yeah, one of the big ones, I think you wrote this one, Will, was about what lenders could be doing to improve their response to hardship measures and that kind of thing. And ASIC sort of found it has some ongoing concerns and some room for improvements.
Exactly, yeah. So essentially, they've released another report this week. If anyone wants some bedtime reading, chunky report, lots of interesting information in there, and it's kind of part of an ongoing review. They've released previous reports, and essentially they've said that lenders need to focus on improving hardship support, but they have acknowledged significant improvements, was how they put it.
Yeah, because they did this big review in 2023. I think they looked at 10 of the largest home loan lenders, and were like, how are you dealing with hardship requests? And of course, in 2023, we were coming off the back of COVID. Lots of people were sort of going back to work. We were in quite a high interest rate environment. So lots of people were looking at hardship and looking at how they could stop going into arrears and talking to their lender. And in that review, I think we wrote about that last year, was it? Was it earlier this year? I can't remember now.
I mean, there were 2. So as you said, started in 2023.
Yeah, I think maybe the first report came out in 2024 and they were like, lenders are not doing a good enough job when it comes to providing hardship support. So this is a new report, which is kind of an update on what's happened since then.
Yeah, it's ongoing review, and they've had third-party reviewing banks as well, not just them. Essentially, they acknowledge improvement, but said some banks are still being too slow, still not going far enough. I'd say there's like a gentle warning would be the tone.
A gentle warning?
Yeah, I would say, is in they do reference quite a lot of penalties that have been issued. Obviously, it ended last week.
Yeah,
last week.
240 million.
And part of that was to do with issues with hardship and support. And I mean, other majors have been given fines, and they kind of mention them and say they're not afraid to issue more fines, and they'll keep reviewing. They didn't give a timeline of when the review would. I imagine it's just ongoing until they feel they can finish. But yeah, interesting stuff about specifically areas they'd like to see improved.
Yeah, and I thought some of the statistics in that report, the hardship one, the sort of progress report almost, if it were, was around looking at how many notices they've had for hardship. And the weird thing for me is ASIC being like, hooray, we've had so many more hardship notices being issued. I'm like, this is a weird thing to champion.
Yeah.
But of course, I think from them, they're saying it's really good to see more people actually putting in a hardship notice and more lenders working proactively with their customers on hardship support before they go into arrears. So I think that's where they kind of are saying that's the good thing. But they were high numbers. So in the March 2025 quarter, almost just over 78,000 hardship notices were issued by these, only I think it's like 10 lenders. I think it's 10. And then in the June quarter, that dropped to 74,000. So 78,000 in the March quarter, 74,000 in the June quarter. But compare that to the same periods last year, and it was about 62,000 and 68,000. So the number of hardship support notices have really gone up. And ASIC was sort of saying that's really good because it shows that lenders have actually been proactive. They're talking to their customers. They're getting more hardship assistance in place. And most of them really for owner-occupiers. I thought the reasoning for why people were accessing hardship support was quite interesting in that report.
Yeah, I guess the argument they make, it's hard to tell if it's fair, but the argument they make, so as you said, the number of cases is rising. It's kind of bumpy, but definitely rising. And they would argue it's because it's easier to detect and they're flagging more and they're giving more support, as opposed to there's just more people in financial distress.
Yeah, let's hope it's not.
Yeah.
But I think, again, like they were sort of saying some of the things they'd also found were that lenders were making it easier for people to access hardship support. I think previously they were kind of making them fill out quite a lot of paperwork, and they were like, they're now doing it sometimes over the phone. It's also a lot quicker, so people are getting resolutions more quickly. But when it comes to actually like why people are going into hardship, the number one thing was overcommitting on their home loan, which I thought was really interesting. 99,852 hardship notices related to home loans were about overcommitment. And that's a bit of a worry, obviously.
So that just means you've just borrowed more than you can afford to take, and for whatever reason it's become
unsustainable, which, you know, currently, obviously, when we look at the two quarters, they were talking about March and June, we're in a falling interest rate environment. You'd hope that people would be finding a bit more breathing space in their loan. But the fact that 99,000 people have come out saying, I've overcommitted on this loan, I can't afford it, I need some hardship assistance, that's worrying, particularly as we come towards the 1st of October, where we get the 95% boom we're expecting, where the caps and the income limits on the first home guarantee are removed. So we'll start to see a big uptick, I imagine, in the number of first home buyers coming out with 95% loans and taking on a big chunk of that, you know, property burden, the mortgage burden. I worry about where that number goes.
There's a bit of a worry because everyone's on that hamster wheel to sort of get a property as soon as they can. And if they can get a property with a smaller deposit and feel like they can afford it, they're probably going to do that. But can they actually afford it, I guess, which is always a big question.
That's why it's so important to work with a broker and look at the budget, look at the repayment schedule, being like, what does that mean for my life? And I think actually a lot of brokers spend a lot of time doing that, actually educating clients on being like, not only can I help you get a mortgage, but also being like, actually look at where you're spending money and how you're assigning your repayments to make sure that you're not really kind of overextending yourself. And of course the lenders should be doing that too, making sure they're not overcommitting. But that was the number one reason that people were asking for hardship assistance, was overcommitment. The second one, reduced income, which, you know, makes sense. Medical needs, unemployment, separation, those are all the kind of expected ones we expect. But yeah, I was really surprised by that. So they were kind of saying there's more work to be done, basically. That's what ASIC was saying to lenders. What sort of things do they want them to be doing?
So a lot of it, I think you mentioned, was about awareness. So lots of people actually don't know that they can flag to banks if they're in financial distress for support. Loads of time around spent actually, I think they've tried to kind of automate aspects of applications to banks. There was a lot on that. Just general assistance, more specialised, more training for in-house staff. I mean, there was a lot in there.
Yeah, I think the one that as well that the in the quotes from the ASIC Commissioner Kate O'Rourke, she was sort of saying we need to see really individualised support. Like it's good having obviously hardship assistance and being fast with it, but don't just provide a blanket solution to everyone because maybe that might not work for them, or maybe they don't need as much assistance as you're giving them. So just making sure it's tailored for the individual, which of course that takes more time.
Yeah, and I think you mentioned employment as one of the big issues, but then if you compare that to just being overstretched in your mortgage, that would be a completely different problem that would need a completely different solution.
Yeah. The other big thing that I think we heard this week, which I thought was really interesting, was from Connective. They'd issued some commentary around the types of complaints we're seeing. It's kind of negative topics we're talking about today. Hardship notices and complaints, but they were talking about broker complaints and some interesting changes that they're seeing in what people are complaining about. Will, again, I think this is one of yours. What were they talking about?
It's not as negative as the previous one. So it's basically, as you said, Connective analysing AFCA data on financial complaints, and they do say actually that the complaints made to brokers aren't necessarily rising, they're just changing in nature, so they're becoming more complex, less predictable, more costly generally to resolve, and we should say they still make up a really small amount of overall financial complaints, which is a good thing.
I think it's less than like 0.5% or something.
Yeah, it's tiny. But yeah, the complexity in particular was raised as an issue, and that's changing. And they used to be confined to more kind of generally straightforward issues like fixed rate break costs or administrative errors, things that you could quite easily resolve. And now it's more to do with like best interest duties or maybe referrals, commercial client arrangements. So they were basically making the point that they'd noticed a clear trend in issues becoming more complex and harder to resolve.
Yeah, because I think like when it was things like overcommitment, let's say, like we were just talking about, or things like I was put into a loan that wasn't suitable for me. It's kind of very different to the best interest duty challenge and being like, what exactly does that mean? And again, this is something that ASIC, to harp on about them even more, is currently looking at. We know they've got that best interest duty review. It's been 5 years since it's been in place. So being like, what does that actually mean? Where are they doing really well, where brokers doing really well, but also where is there room for improvement? So we're really curious to see what comes out from that review and that sort of undertaking of looking at how that goes. But I think that's interesting, talking about what Connective's been seeing. What are they suggesting brokers do about it?
So a lot of it was around strengthening risk management, so better record keeping, which sounds basic, but I think if you're having constant phone calls, it would be easily to kind of misstep. Scrutinising documents carefully, document verification, again, a lot of kind of tech plays into it, and education and general kind of compliance knowledge was also flagged. Yeah.
So making sure you got a good like audit trail and evidence of what you've been talking about, being able to show what you talked about, and obviously staying across all your compliance. We'll take a quick break here. When we come back, we'll be talking about what's happening next week, rate decision, exciting for everyone, and what some of the lenders think will happen, and also what they think will happen to the cash rate trajectory more broadly. We'll get into that just after this message. So next Tuesday, firstly, it will be October next week. Can you believe that? But before that, we have the cash rate decision on Tuesday the 30th from Central Bank, the Reserve Bank of Australia, the September decision. Of course, we know we don't have rate decisions every month nowadays, but this one is coming up September. I think the next one after that will be November. But I think what we've been hearing for the last few months has been most people saying we don't expect there to be a cash rate change. What do you guys reckon? Have you got any money on what the RBA will do on Tuesday, Ben?
I think this isn't advice, but I think they're going to hold probably. Yeah. I think based on what we're seeing with the CPI and everything.
Any counter? Holds. I think 100%. Hold too. We're unanimous. Yeah. We are all holds for September. But what do the lenders think, the actual economists that are deep diving into this? I think, Will, you wrote a story this morning about some forecasts.
So essentially, monthly inflation came in this week, and it came in basically higher than expected. And all the majors kept their predictions the same, so none of them are predicting cut next week. And NAB actually revised their forecast quite substantially. So they were predicting cuts in November and February, and now they're saying there's not going to be any cuts till May, given the kind of data. A lot of it was around inflation. So some still predicting November cuts, but I think the general consensus, certainly like the market's predicting a hold next week.
Yeah, okay. I think that's really interesting, the future outlook, because I think so many people were talking about definitely a November rate cut. I think actually nearly all of them had said, all the major banks had said a November rate cut.
At one stage, yeah.
Yeah, and now that's kind of been easing back. Even Westpac this morning, I think, was saying, we kind of think there's still going to be a November rate cut, but we're not certain about that. So they're also easing back. I think Lucy Ellis put out a note this morning that I was reading saying we continue to expect the RBA will cut the cash rate further over time. While November timing of the next cut is now less certain, it remains their base case. Base case, it's hard to say. But yeah, and I think NAB, though, saying no, May 2026 will be the next cut, which personally don't like that. I'm going to go with Lucy Ellis from Westpac.
It's a big call, that, because a lot can happen between now and May.
And this is also only monthly CPI data they were talking about. So we had that come out this week. Again, sort of showing that inflation may be a bit higher than they want. What's sort of been driving that?
Part of it was to dwellings, house prices, services was a big one, electricity costs. I know that's kind of taken out of the underlying figure because of government rebates, but that was a big factor. And I think last month it didn't accelerate quite as much as people expected, but it was still a bit higher, and then that trend has continued. I think the consensus is that the quarterly figure is going to be higher than expected, which will probably give confidence to hold interest rates for the time being.
And I think also we've heard Michelle Bullock speaking, was it this week? Maybe it was last week.
Tuesday?
Monday,
and
she was talking about spending going back up again, so sentiment, confidence being a bit higher. So maybe not needing to cut rates immediately, perhaps sort of people are feeling a bit more at ease. But of course, so not wanting to keep policy being super restrictive either. So I think sort of keeping a fine balance between not being restrictive, not being too loose. So kind of saying maybe we'll sit on this for a bit.
Yeah, the wording's always interesting from all the economists and the RBA, and it's definitely consistently cautious, and it's probably got more cautious as the month's gone on. I'd say on Monday, they're not going to say what they're going to do, but I'd say tonally it sounded like
hold.
Yeah, I think so.
Yeah. And I think this again shows how quickly things change, because with NAB saying now only expecting a cut in May, not in November, that goes quite differently to what Westpac is saying, which is November, February and May. So I'm a bit again, I'm siding with Westpac here because I'd like my mortgage to go down a little bit more. But I think that's really interesting seeing how they read the figures, what they think about the figures. And of course, these things change pretty quickly as well. Once we get more data, they're constantly changing. So I feel like we start writing a story, by the time we file it, we have to revise it because it's sort of, changed so quickly. Ben, do you reckon there'll be multiple cuts in the next 6 months?
It's hard to say. I think it's weird to sort of view the current sort of trajectory of the cash rate target as sort of a rate cutting cycle, but there's a lot of water to go under the bridge until the next sort of decision. So we could be looking at a completely different economic landscape, and then does the RBA want to the RBA if they don't see an incentive to sort of cut, they're not going to do it. So.
Yeah, and we're also seeing, such strong demand again from mortgages and people borrowing because of the fact that rates have been coming down. So I think this will also feed into what is happening. As we mentioned already, the October home guarantee scheme, the expanded one will start next week. So we'll obviously be talking about that a lot next week. But I think also looking at, well, what does that mean for demand? And we've already started to see some data come through from different parts of the industry, whether that's from official sources like APRA and the ASIC lending data about mortgage demand, or from the associations. And also now I think from property and settlement businesses too.
Yeah, so Equifax data, and essentially saying just that mortgage demand has increased in line with the cash rate. So from February, it's gone up. It's been kind of bumpy this winter. I still find it so
Can't get over that.
Yeah.
Northern Hemisphere, Southern Hemisphere.
So it actually dropped in the last month, but generally it's gone up, and they expect with the spring selling season to keep going up.
Do we know how much by?
So in terms of what it's gone up by, down 5.1% on the month on month, but actually year on year, it's for the year, it's 5.2% higher than the same period last year. So quite a clear increase.
Yeah.
And yeah, I mean, the common forecast would be that that'll keep going up as rates drop.
Dependent on what house prices do, obviously.
Yes.
Yeah.
And things like the Home Guarantee Scheme, no one quite knows how much that will contribute to demand.
Yeah, we're seeing a lot of commentary on our sister title, First Property Buyer, people really waiting for the Home Guarantee Scheme to open next week, and kind of seeing that kind of engagement, and people really, really worried about what's happening to house prices and what will happen to house prices moving forward. I think there was some new records set this week for property. I think there was the highest ever property price that went to auction. It was over $40 million. A property went to auction and sold at that. It was in Rose Bay. I think it's in Rose Bay.
Sounds right.
Yeah.
I just missed out on that one.
Damn. But yeah, lots of good stuff coming on next week. So of course we'll be covering the cash rate decision on Tuesday. We'll be talking about all the forecast updates as we hear more from the central bank governor, Michelle Bullock. And generally just looking forward, it'll be October and the Home Guarantee Scheme, as we said. So we'll be talking about all that next week. It's going to be another busy week next week. So rest up over the weekend. Any nice weekend plans, Ben?
I'll probably watch the grand final on Saturday.
You get they have a holiday in Victoria today for it. Yeah. Watching that, are you barracking for a certain team?
Not really, just observing the spectacle. But hopefully it's a good game.
Yeah. Keeping yourself neutral there.
Yeah.
Don't want to anger any listeners. Will, for you?
No.
Off to New Zealand tomorrow.
Yes, that's right,
really
Queenstown. Yeah.
You up to much?
Well, apparently it's going to be 30 degrees here on Saturday.
Nice.
So probably go to the beach.
Good shout.
Yeah.
Good idea.
But other than that, not much. Thanks for your time, gents, and joining us on What's Making Headlines. And thank you all for tuning in. If you've got any questions for me, Ben or Will, you can reach out. You can reach me, editor@theadvisor.com.au. Of course, take a read back at all the stories we've covered today. They're all there, theadvisor.com.au. And if you're interested in learning more about what's happening in the mortgage market, what's happening in the broking industry, then do take a listen back to previous episodes here on the Advisor Podcast Network. We'll catch you next time for another episode. Have a good weekend.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.